Live from our studio here in New York, we're watching this afternoon. We're an hour away now from the close on Wall Street, and the selling accelerating here. Stocks are near the lows of the day as markets come off a long holiday weekend, and the 10-year yield hovering above 4% as one Fed official says rate cuts shouldn't be rushed.
Plus, JetBlue's proposed merger with Spirit Airlines blocked. It's a victory for Biden's Justice Department as a judge says that if the deal went through, it could hurt price-sensitive consumers. Spirit shares plunging on the news. We're going to get an analyst's reaction later this hour.
And Elon Musk raising eyebrows with his demand for more control over Tesla. Says the control is necessary before the company can meet its goals on AI. We're going to hear from one Tesla shareholder about this plan straight ahead.
Let's get you up to speed on the market action today. Across the major indices, we're seeing a lot of red on our screen here. The Dow Jones down about 0.8%, mainly getting pulled down by Boeing, but seeing red too in the other major indices. The S&P 500 down by 0.5%, and the Nasdaq down by 0.3% as well. And we'll talk about the specific news, company-related news that's pulling down some of those major indices, including Apple and Tesla pulling them down. But I'm really interested in the Fed speak from today. I think that is one of the primary drivers of the market moves today. Fed Governor Waller saying, he's anticipating 3 rate cuts, the market pricing in about half a dozen. I want to take a look at one specific quote here. He said that with economic activity and labor markets in good shape, inflation coming down gradually to 2%, I see no reason to move as quickly or cut as rapidly as in the past. Market doesn't want to hear that. They don't want to hear no reason to move quickly when it comes to rate cuts, particularly when they're pricing in 6 rate cuts to come for the year, Josh. And it was interesting to watch the bond market in particular today. We saw yields rising, stocks also dropping as well. But then we saw something a little interesting, real money buying what I'm claiming to be the Waller dip when it comes to the bond market. So interesting to see just how the market is parsing this slightly hawkish but then slightly dovish commentary from him.
Yeah, I thought it was also when he said here, inflation is cooled. Inflation is moving in the direction we want to see. But then he said concerns about, and here was the word, sustainability of these data trends requires changes in the path of policy to be carefully calibrated and not rushed. And that word sustainability to a lot of strategists, that was critical. So when will that sustainability be achieved? When do we get back to that 2% Fed target and really maintain there? Waller's saying, I think we're close, but I will need more information in the coming months. And remember, of course, we're not waiting for that December core PCE data, which of course is policymakers like Waller, that's what they're focused on, and what they're going to be waiting for. But I think that's a key word there that really stood out to a lot of folks. Not just when you hit the 2%, but how do you maintain there? How do you hold there?
Right, and that's what Jay Powell has been saying for so long, data dependent, data dependent. He kind of echoed that. But to your point, we are getting some market reaction already, particularly when it comes to the research. We have Goldman Sachs coming out with their note in response to Waller's comments today, saying that the comments raise the risk that the first cut could come slightly later than Goldman's forecast of March, and that the pace of cuts could be quarterly from the outset rather than the forecast of 3 initial cuts. But they don't see those comments at odds with their forecast of a baseline for a first cut in March and 5 cuts total for 2024. So not a huge change to their outlook, but potentially a change to the timeline of that outlook there.
Yeah, really interesting. One story we're going to keep watching there for sure. Meanwhile, a federal judge blocking JetBlue Airways' purchase of Spirit Airlines. That proposed $3.8 billion deal would have produced the country's 5th largest airline. So this one is interesting as well here. This is another deal, another win for the DOJ. It'll be interesting, I think, to just talk about, listen, does JetBlue, does Spirit, do they try to appeal this? If so, is it in their interest to appeal this?
Well, it's interesting because we've seen a more hawkish Justice Department when it comes to M&A activity. But when I speak to folks in the M&A space, they say that doesn't halt deals. That's just a delay. That's what CEO of Solomon Partners, Mark Cooper, has told us multiple times on our program. I wonder what they think their strategy is going to be. We're going to be able to talk to our guest about that in a little bit. But this does feel like a win for the consumer because the judge really dialing in on this idea that this is a about competitive pricing, that Spirit is the most affordable airline for consumers, and that by these two merging, there wouldn't be an airline to push the other airlines to decrease their prices.
Yeah, I mean, certainly for the judge, he's agreeing with the DOJ on that issue. I think certainly JetBlue and Spirit, obviously they don't believe this is going to hurt competition. Sure. They don't believe this is going to hurt consumers. It will be interesting, do they appeal this? Or, listen, is another airline capable of coming in here and making some type of pitch for Spirit that could in some way get past regulators? We'll see.
That's interesting. Also, I wonder if maybe the market movement that we saw today could change that dynamic. Spirit hitting their lowest market cap ever. Does that maybe open them up for a couple of more customers coming to the table for them?
Yeah, we'll see. All right, switching gears to another big story today. Tesla CEO Elon Musk threatening he needs more control of Tesla if the company's AI ambitions are going to be met. Tweeting today, he said, "I am uncomfortable growing Tesla to be a leader in AI robotics without having 25% voting control, enough to be influential, but not so much that I can't be overturned." Let's see how investors are taking this news. Ross Gerber, CEO and president of Gerber Kawasaki Wealth and Investment Management, joins us now. Ross, it is always good to see you. So let me get your take on this, Ross. Elon Musk has taken this fight public. What do you think?
I think he should buy the stock. I think he should use his money and buy 3% of Tesla for, $25 or $30 billion like the rest of us. I think the idea that shareholders should just give him $30 billion of stock so that he'll do his actual fiduciary duty to the company, which is building the AI robotics company he sold us all on. Like, I'm very confused by all this. His job as CEO is actually to build this AI robotics Tesla company that he's being paid already $50 billion to do. So I don't know. I think this is absurd. Elon's friends and relatives are on the board of directors of Tesla. Nobody has any influence over Tesla except Elon. And so I don't know what he's talking about.
Ross, tell us how you really feel. And great to talk with you, by the way. It's Madison. I'm curious.
Hi.
What is this really about? Is this about this philosophical AI? What is that going to do for our society? Or is it about more control of the company? Or is it about a salary issue? What is this about here?
Well, when you have $200 billion and you don't even care about living in a regular house and sleeping in a regular bed, it's not about money. Okay, so this is about the fact that I tweeted that Grok is not owned by Tesla. And to put Gronk, or whatever this thing is called, on Tesla is a conflict of interest. And that Tesla should have an LLM model already on their cars, because if you talk to your Tesla, it's like worse than Siri. So like the fact that I can already talk to my computer through chat and Microsoft products and have an incredible, AI assistant already with Microsoft products, but Tesla hasn't put anything on the car, I should be able to talk to my Tesla and tell it what to do right now, is a total failure, not only in the board and making sure that Tesla's focused on Tesla, but the CEO of Tesla is actually focused on Tesla. So, to me, this is really troubling.
And Ross, I'm just interested in this this threat that Musk is basically making here. He's saying, listen, give me 25% voting control, or I may take my AI and robotics products someplace else. You're in Tesla. How much of a risk really do you see that?
Well, I see this as a fundamental change in the story of Tesla, and it started 2 years ago. It's taken me about a year to fully grasp the fundamental change in the story in Tesla, but now it's been solidified exactly what I feared, which is Elon has full control of XAI, and he wants to build his best products and services under his full control and not for Tesla shareholders, even though he owns and controls the company. I think he wants to own 100% of this. So, it's just so many conflicts of interest. It's never existed in business history. And I think shareholders of Tesla, which I am one, have to consider this in their valuation and in their modeling of where this should be in your portfolio, which we have. And you can see that in my fund, GK, that Tesla's not only dropped in its weighting overall because it's underperformed, but also we've cut our position back in our fund over the last several months, as you've seen.
Ross, from the perspective of retail investors specifically, is more control for Elon Musk at Tesla bullish or bearish?
Hold on. What do you mean by more control? Okay, nobody controls Tesla but Elon. The board is his brother.
But in terms of the voting, Josh, that he's talking about.
Listen, index funds own 30% of Tesla. They don't vote anything. Elon owns 13%. Okay, you see what I'm saying? Like, there's nobody that can take control of Tesla. There's nobody. You would need hundreds and hundreds of billions of dollars of cash to buy the stock. So the notion that he doesn't control Tesla's the closest thing to a private company that's a public company. Okay, it's not run like regular public companies. Come on. I mean, it's just this whole thing is, we've entered this reality distortion effect like 5x now. And it's just, the X Twitter world is not the real world. And that's the world Elon lives in. And it's just not the world the rest of us live in. And so I think we're just seeing this full-fledged.
And Ross, you mentioned, listen, you're still in Tesla stock. You might have trimmed,
yeah,
but you're still in there. Looking ahead now in 2024, what are the catalysts as a Tesla investor, Ross, you're looking for that you think can move this stock higher?
So it's all about earnings for me. Like, it doesn't matter what stock you have. If earnings aren't going up, it's very hard for a stock to go up, and especially one with a 60 forward price earnings. So earnings have to go up, and earnings estimates continue to go down as they discount car prices. And now we're at $375 a share for this year. So you can see that this has been a massive decline in the earnings potential of the company. So I think the question is, what will help them beat these estimates? And obviously the best thing would be is if they could hold pricing on the cars constant and margins wouldn't continue to shrink and volumes would increase. That would be bullish. And if they are able to launch and really like ramp the Cybertruck, which I fear is going to be much more difficult and expensive than they, assume. So if we get Cybertruck out in real volumes and keep pricing on the Model Y constant, Tesla has some upside. But I think right now, Tesla's a mature company looking at a lot of, challenges looking in front of them with an unfocused CEO. And I think at its current multiple, represents a certain level of risk in the stock that didn't exist before. And I think investors should pay heed and look at their portfolio. I love the company and I love Tesla's mission, but I, also have to look at the reality of the challenges the company faces.
So talk to me about those challenges, Ross. What's the single biggest one you anticipate for this year?
Well, the single biggest one I see is really around full self-driving, the fact that it still doesn't work. And, year after year, this is supposed to happen. When you think about technology and AI, it's an AI application. A car can drive itself. That's what they've been promising. They call it full self-driving. And the fact that we're not still, in version 12 or some version that's completed, it's a risk for Tesla long term. Like, what happens if they can't, like, it's plateaued, they can't get better from where they are today? And so, I think that's a big risk for the company. Other than that, I think Tesla needs to advertise and it needs to move away from the identity of Elon Musk to really defining its own identity and developing new demand from new customers, because 90% of people still don't own an EV and probably would want one. So we need to address those markets. So Tesla has some challenges, but it also has a lot of potential upside if the company's managed correctly.
Right, it's all about that market share combined with the fundamentals there, Ross. Thank you so much for joining us to talk about that. We really appreciate you coming on our program. And we're just getting started here on Yahoo Finance Live. We've got coverage all week from the World Economic Forum in Davos, Switzerland, where the 2024 U.S. presidential election is top of mind for a lot of the world's biggest leaders. Here's what we heard from folks earlier today.
In every meeting I've been in, that's what people are talking about, is what happens in the South China Sea, what happens with Putin, what happens with the United States.
Only thing standing in the way of Trump winning is 81-year-old Joe Biden, who has a record to run on, but also has a lot of people that feel like he's not actually up to the job. And that is a serious concern for a former president who refused to accept the free and fair transfer of power. Our democracy is not well functioning. It is a democracy in crisis. And yes, that is the top issue being discussed at Davos.
Our job is not to predict elections. Our job is to be able to go no matter what the circumstances. Our job as the business community and as Bank of America is to help governments be successful. Because if they're successful, we're going to be successful.
We'll dive deeper into the fallout from Donald Trump's victory at the Iowa caucus with BTIG's Director of Policy Research, IXIC Boltanski. That's coming up next. We're a little over 40 minutes away from the closing bell. We're going to get a check on some of the trending tickers moving markets today. Shares of chipmakers AMD, Micron, and Nvidia moving higher today. That was following price target hikes from KeyBank Capital Markets. The analyst over there, John Vin, reaffirming his overweight ratings for 3 semiconductors and also raising his price targets. Let's go through some of those here. 195 from 170 for AMD, 740 from 650 for Nvidia, and 115 from 100 for Micron. And this is a big deal, particularly because it moved the markets, obviously, right? We saw AMD stock up a little over 6%, nearing 7 throughout the day. Nvidia up 2.3% and Micron up 2.6% in Tuesday's trade. We also saw some positive feedback for AMD's AI products and their server processors, with increased demand for their MI300X, gaining a little bit of market share there. And Nvidia's next-gen AI chip expected to come in Q3 with 50% better performance and 40% higher pricing, also giving their stock a little bit of a bump when that was announced at CES earlier on. So seeing a lot of that continued demand for chips moving these stocks higher and making the analyst ratings a little bit more positive, Josh.
Yeah, so I thought the money line in the note was when the analyst kind of went through his checks, right? And they actually indicated kind of what's interesting is kind of a mixed backdrop, because he says broad-based end demand trends actually remain weak. That's what he told his clients. So auto industrial dealing with inventory destocking. Says PCs bouncing along the bottom. Traditional server weak, right? But AI, that was kind of the standout, because AI, in contrast, according to his checks again, remains strong. So that's why the analyst here was reaffirming, hey, I'm gonna stick with my overweight ratings on AMD, Nvidia, Micron. I'm gonna raise their price targets. As you said, his checks sound like they were most favorable for AMD. Of course, you look at some of these names, Madison. I mean, they already had just huge runs, right? And AMD hit a 52-week high in today's trade. Stocks up about 120% over the past 12 months. And then, of course, Nvidia, tons of love for Nvidia, right? We know that up about 220% over the past 12 months.
Yeah, huge year for them, Josh.
All right, moving on. Let's got shares of Boeing down big today. That says the return of the 737 MAX deliveries to China hit with further delays. This is according to the Wall Street Journal. China's Southern Airlines is planning additional safety inspections on undelivered MAX jets. So this one's a few different headlines here. I mean, listen, first of all, Boeing, it has been a rough start to 2024 for a lot of reasons, one of which, just check out the stock. It's now down about 20%, Madison, so far this year. Of course, that follows this incident on the Alaska Airlines flight and all the kind of ripple effects we've seen from that. For investors, one key question there has clearly been how this impacts kind of deliveries going forward. And now you do see these analysts kind of weighing in. Team at Wells Fargo cut their rating to equal weight, so hold now, talking about the risk here on deliveries.
Yeah, it's interesting because it begs the question, is it time to buy the Boeing stock? And if you listen to the analyst ratings, that's a hard no when you look at this name, right? But if you look at the stock, it's obviously on sale. If you look at it from one perspective, if you look at it from another, the stock is tanking on some negative headlines. The question is whether or not it's a good investment. The Zacks consensus estimate for the current year has increased 5.7% over the past month. So that revision a little bit bullish on the name, but it's just, I think you got to wait for this FAA investigation to continue to play out. And we're seeing the analyst ratings pricing in some negative headlines to come from that investigation. We're going to continue to move on the market trending tickers here. Some bank earnings. Goldman Sachs trading higher today after beating fourth quarter earnings results while simultaneously posting the bank's lowest annual profit since 2019. Shares of Morgan Stanley in the red after the company's reported fixed income and equities trading revenue fell short of Wall Street expectations. Overall, beating top line forecasts. It's so funny because it felt like I was going into this week, big bank earnings were going to be the news following that big beat from JP Morgan on Friday. And then we had those Waller comments really pouring cold water on my coverage plans here when it comes to the big banks. I thought it was really interesting, though, hearing from Morgan Stanley's CEO warning of the geopolitical risks ahead, specifically citing the amount of downside risks to come that could weigh on the bank in 2024. Again, intensifying geopolitical risks and the state of the U.S. economy. but reiterating, though, the base case of a soft landing as well.
Yeah, Morgan Stanley, so a new man in charge over there, Ted Pick, has taken over. Tough welcome for Mr. Pick in today's trade. A key metric here, it sounds like really net revenue from the wealth unit, $6.65 billion. That was higher than what the street expected, but then it sounds like that focus on wealth management margins, reported a pre-tax margin 24.9% for the full year, and then execs saying on the call that margins could consolidate in kind of the mid-20s range over the near term, and perhaps that was kind of a drag on the stock.
Yeah, and finding ways to gain revenue and market share outside of the investment banking business, which we know has been weighed down a little bit by the decline in deal making. But we're going to move on a little bit. We're going to talk about former President Donald Trump winning the Iowa caucus in a landslide over rivals Ron DeSantis and Nikki Haley, with Trump taking more than 50% of the vote. Many wondering, are the rest of the primaries a formality? Joining us now to discuss, we've got BTIG Director of Policy Research, IXIC Boltanski. And Isaac, thanks so much for sticking around with us. We appreciate it. I'm curious, when we think about what happened last night in the Iowa caucus, and then we think about what's to come in New Hampshire, to what extent is there a read-through between these two events?
Yeah, look, I think when we take a step back, Trump was expected to win Iowa. He won Iowa. He crushed in Iowa just as expected. To me, the most important undercurrent from last night is that Ron DeSantis got second place. If he was in third place, I think that we would be talking about him dropping out today, at which point you could see some of the Trump opposition coalesce around Nikki Haley. But it looks like he's on to New Hampshire, which means that that Trump opposition remains fractured, which is the best possible news for the former president. President Trump going into New Hampshire with his opposition fractured, he's still ahead in the polls. And I think that his campaign is feeling very optimistic today, as they should, after not just what happened last night, but also going into New Hampshire knowing that the anti-Trump wing of the party still hasn't picked its horse.
But do you think, Isaac, I mean, put your bet down for me here. Bottom line, do you think this is a done deal? It's Trump versus Biden?
Yeah, no, look, yes. The simple answer is yes. I think there's Trump v. Biden in 2024. And what I found interesting, both from our DC contacts and our market clients, there has been a fair amount of folks just brushing that off, who don't want to believe it's, after all of this, it's going to be Biden v. Trump again. There is still some belief in some corners, some hopium, some might say, that you might get other candidates who will rise up. Trump is the powerhouse right now on the Republican side. I think the way that the primaries are structured with winner take all, this is his race. I think that he will be clearly the nominee around Super Tuesday, which is March 5th. That'll be done. And Biden is the presumptive nominee. Doesn't matter what Congressman Dean Phillips is trying to do. Biden will be the nominee. So after all of this, in 4 years, it looks like we're going to have a rematch of the 2020 race.
So let me ask you, Isaac, if it's going to be Trump and Biden, I'm just curious, who drops out first then? Is it DeSantis or Haley? And when do you think they drop out? Is Haley before or after South Carolina?
Yeah, look, I think that Haley stays in through South Carolina. My sense of this is that you're going to see DeSantis drop out shortly after New Hampshire. I don't think that he is going to have a strong showing in New Hampshire. And let's keep in mind, let's look at the historical precedent here. Iowa has not been good at picking who the nominee is. If you look back at the 7 previous GOP primaries, they've only picked right twice. New Hampshire has picked correctly 5 times. And part of that is because there is a more moderate bend to the electorate in the GOP side in New Hampshire. And I think that we've seen DeSantis move to the right and try to move even to the right of Trump on some issues. That's going to hurt him in New Hampshire. And so I think that he will drop out, and I think that you will see some of those voters move to Nikki Haley. I think you'll see others just simply stay home during primary day. And all of that adds up to Trump being the presidential nominee for the Republican Party.
And Isaac, I was on the campaign trail in 2016 and 2020, and we've learned that it really comes down to a handful of states to the tune of 7. What do you know about what the polling indicates to us about what is going to decide for voters, what they are going to decide on when they enter the voting booths in those 7 states?
You know, first, I'll parrot the Federal Reserve Chairman and say I think we should all be humble as we think about this. No one knows what we're going to be talking about in 3 months, let alone in November of next year. What I tell my clients, though, is that this is going to be an incredibly close race. And you don't need me to tell you that. Just look at 2020.
Right.
We saw an election that was decided by 44,000 voters in 3 states. And you didn't have some of the competing complexities that we have now, including an economy that anyone who says they understand isn't paying attention. And you have a geopolitical dynamic that continues to show how volatile it's going to be. And then, in case we needed more to make it difficult, you've got third-party candidates who can swing any of these individual states. It's going to be incredibly close. It's going to be contested, and it's going to be down to the wire.
Isaac, let's switch gears and talk about what's going on in Washington as well. We're just, what are we, Isaac, about 3 days here from a partial government shutdown. A lot of moving pieces and dynamics at play here. How do you see that playing out?
You know, we're in earnings season, right? And this is all about managing expectations. And when we think about back on this Congress, expectations were exceedingly low for them to do anything. And yet they continue to miss those even exceedingly low expectations with their performance. My sense of this is that we will get an agreement that funds the government into March. It will be a laddered approach that gives us 2 different deadlines. March 1st and March 8th is what they're circling. Maybe you push those back a little bit further. But it strikes me, and I think it's noteworthy here, that we are already months into the 2024 fiscal year, and we're still fighting over budget levels. And that tells you how divided Congress is, how inept this Congress is. But it also shows, and I think underscores, that they're trying to build a Christmas tree right now. And they realize that they have so much unfinished work, that they're now trying to build a Christmas tree that'll allow everyone to hang an ornament on it. You can have one ornament for Ukraine funding, another for border spending, another with this tax deal that we've heard. And that's really the only option for anything to happen, because they have failed miserably to move any specific legislative proposals across the goal line.
Well, Isaac, let's talk about that tax deal that you mentioned. They did strike a deal, $78 billion one. Talk to us about that tax credit, what people need to know about it, and what the passage of it and that bipartisanship indicates to you about what lawmakers may be able to tackle on the policy front moving forward.
You know, there's a phrase that I always come back to, which is a good compromise should leave everyone a little bit unhappy. And that's what this tax package is. You have something that makes Republicans happy, which is extending some expired business tax credits. And here I'm referencing the R&D tax credit, the EBITDA tax credit, and then the expensing tax credit. All of these should be good for capital-intensive companies in the utility space and the manufacturing space. And you couple that with an extension and expansion, not as generous as we've seen before, but an extension and expansion of the child tax credit, which is something the Democrats have been fighting for. This should become law. We just need to make sure that there is a Christmas tree, as I mentioned before, a broader legislative vehicle in the form of a budget agreement that allows it to catch a ride to the president's desk.
Isaac, it was so good to have you on the show today. Thanks so much for your time and helping us navigate all these issues. We appreciate it.
Thank you.
Meanwhile, Apple hitting multiple headlines today as it makes changes to products, slashes prices in China, and gets a no in an appeal to the Supreme Court. Let's start with the latest changes that are being made to the Apple Watch, being redesigned to bypass an import ban after the medical tech company Masimo sued for patent infringement. Let's bring in Dan Howley. Dan, what is the very latest?
Yeah, that's essentially, what we see going on right now is Massimo saying that Apple is going to change up the Apple Watch Series 9 and Apple Watch Ultra 2 to remove that blood oxygen sensor feature. Basically, that's the reason why there was that import ban. That's why there was that sales freeze just ahead of the holidays and then the unfreeze. And so without that capability, it looks as though Apple's going to be able to bring more Apple Watches into the U.S. and continue to sell them over time. It does mean that U.S. consumers won't get access to the feature. Those outside of the U.S. will still be able to use it. This is a U.S.-specific issue that's going on. And so, if you are not in the U.S., you'll still be able to use the blood oxygen sensor. In general, I haven't found it to be entirely useful overall. If it was a feature like, say, the actual heart rate monitor, then that would be, I think, something that would be a huge problem for Apple. But overall, the blood oxygen sensor, in my sense, doesn't really add much to the experience. So I don't see it as being a huge issue for Apple, especially when it comes to shipping the watches that it currently has on the market, or that it will bring to market without the sensor itself.
Dan, let's double click on these discounts coming out of China. Analysts warning that the sales in China could continue to fall. They're slashing price targets on the name as a result. I'm curious if the discounts in China indicate a belief in the slowing demand story. Does it bolster the investor concern about the slowing demand story for Apple? And what does that mean about that demand moving forward?
Yeah, it's definitely not going to help people alleviate their concerns, right? We saw a handful of analysts downgrade Apple over the past 2 weeks or so, pointing to the issue with China, as well as antitrust concerns, but really, China and the slowing of sales there, because the general malaise the economy is in over there, but because of an increase in competition from the likes of, believe it or not, Huawei, which has started to pick up again as it's using new chips that previously it wasn't able to get its hands on. So now kind of the homegrown hero is back for China, and it means that, look, they're going to be able to offer these products with similar capabilities, not exactly the same capabilities, but similar capabilities that Apple is able to offer at a lower price. And that's going to mean it's going to put some hurting on Apple as far as, how many people go out and actually purchase it. Now, this isn't necessarily a long-term problem. Apple could be able to pick things up with its next generation of phones, but there's also concerns there as to whether there's going to be something worth buying when it comes to the 16 versus the 15.
All right, Dan, thank you so much. And move on, another headwind for Apple to keep in mind here is the Supreme Court not taking up the antitrust fight over the tech giant's App Store. Alexis Keenan is here with those details. Alexis.
Hey there. Yeah, so it was back in 2021 when Epic first sued Apple as well as Google, alleging that their mobile app stores were blocking competition. Now, that was after both companies removed Epic from their respective app stores. As far as the Apple Epic case, that went to a federal district court in California. It also went to an appeals court, the Ninth Circuit. With neither side being happy, both sides appealed to the Supreme Court, and today the Supreme Court declining to take up that matter any further. Now, what that means is that the lower court's injunction that was put on hold pending the Supreme Court's decision whether to take up the case, that's going to go into effect. And that could mean some bad news for Apple, because while those court rulings mostly favor Apple, finding that the App Store was not an illegal monopoly, what it does is require that app developers, that Apple must let these app developers include in their apps things like links and buttons so that their users in those apps can pay for app purchases outside the App Store. Now, that's critical because although Apple was spared from having to, let's say, potentially divest the App Store or reconfigure the App Store, it is a huge revenue driver for the company. At the time of the trial, the appellate court had said that the gaming apps alone generate approximately $100 billion annually. And also at the time of the trial, they said that there were 30 million iOS app developers and more than 300,000 iOS gaming apps. Now, Apple's store is part of what it puts into this bucket of revenues called its services line of business. And the company doesn't break out specifically App Store revenues, but the segment, guys, in this most recent year in 2023 generated $383.3 billion in total revenue for the company. Guys?
Alexis, always giving us the great context here. And thank you so much both to you, Alexis Keenan, and our own Dan Howley for breaking down the market movement as well on this name. Now, coming up, the newest edition of our series, Goodbye or Goodbye. We'll get analyst insight to break down two stocks and help you make the best choices for your portfolio. Stay tuned.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise, to navigate the best moves for your portfolio. And today we're diving into the construction and infrastructure sector. Here with the best way to play this space, we have Moritz Pott, Tema's ETF founder and CEO. Moritz, great to see you. Thank you for joining us.
Thanks for having me on the show today.
So what I love about this pick, Moritz, is that you're not coming with Microsoft or Apple, Nvidia. This is a different name, one that maybe our viewers don't know so much about. Ferrovial. So maybe Moritz, just start quickly. What does Ferrovial do? What's the business here?
Ferrovial is a global infrastructure player with a big focus in the US. They own toll roads, big infrastructure projects, civilian infrastructure. So for example, they own the biggest toll road in North America. They own toll roads in Dallas, in Atlanta, New Jersey. And Ferrovial is really it's a firm that has a long history of operating in the space. It's done some of the best and biggest deals in the space. They manage capital allocation very carefully. They are very competitive. Yes, they are historically been Spanish, but rather most of their business is in North America. They're actually relisting to Nasdaq this quarter.
And I want to stop you there because when you go through the bullets, Moritz, when you're trying to make your bullish case here, this is the first one. Let's just walk through this. The first point you're making here and why this name is a buy, transitioning to a listing at Nasdaq. Walk us through why that's bullish.
So I think the bullish is that in reality there's more buyers for the stock on Nasdaq. The majority of the exposure in Ferrovial is in North America, not in Spain. So frankly, there's just there's a re-rating story, in addition to which I think there's an awareness story around what this company is doing in North America. So I think this is at the heart of what you're seeing with the infrastructure boom in North America. Infrastructure in North America, as you know, is a very hot topic right now. You saw BlackRock doing a deal last Friday. You saw General Atlantic doing a deal today, both in the infrastructure space. So infrastructure is a space where I think there's going to be more and more interest. Ferrovial has been a long-time player in the space and done very successfully.
It's been a big headline maker. Second point here, walk us through. Substantial cash flows are expected.
Yeah, I mean, if you look at the business, it's been investing for a long time, but the reality, they're not putting up prices on some of the toll roads, so you're expected to see some material release of cash flow in the coming years as some of the capex cycles fade, and also you see some of the price increases come through, specifically on the toll road business.
All right.
So this is, of course, historically a capex-intensive business, but they manage capital very carefully, and in addition to which they generate significant cash flow.
And finally here, likely to invest in and build more great assets.
I mean, I think right now there's an infrastructure boom that's happening in the US, helped by several of the recent acts we've seen in the government. Ferrovial is well positioned to be a beneficiary of the projects coming out of that, and it has already been. Highway upgrades, new highway builds. For example, they're the lead bidder on the S400 toll road coming out of Atlanta. Ferrovial is a US leader in the infrastructure space, and the government, I think, is very focused on improving the infrastructure in this country.
All right, now you've made a very convincing case here, Moritz, but let's say, viewers, they're watching right now, before they dive headlong here, commit capital to the name, what are some risks they need to think about here?
I think some of the risks are that, the reality there could be a slowdown in government spending on infrastructure short term, especially in the election year. We don't know what could change in the election year. I think the reality is that if there's a slowdown in general construction, Ferrovial will be impacted short term. Long term, we think Ferrovial is very well positioned, and Ferrovial takes a very long term approach to the way it manages business, which we like. It manages risk carefully. There's always risk in construction projects. Historically, Ferrovial has managed those risks very well, better than its competitors.
All right, so you're bullish on that name. Let's talk about a name you're not bullish on, one you would avoid, and that is Mastech. Again, maybe for this name, quickly explain what Mastech does. What's the business here?
Yeah, so it's really an infrastructure and construction provider in the energy and renewable space. I think it saw a lot of hype, a lot of interest in 2021. I think it's frankly it's proven to be a challenge story, and I think
stretched balance sheet is one reason.
Stretched balance sheet. So I think it doesn't manage capital as well. I think it structurally has a difficult balance sheet to start with. Yeah, I think it obviously in 2022 you saw a big boom in the spend. I think that's really receded very quickly. I think the secular story is not the same as with Ferrovial. And I think recently you've really seen a collapse in the cash flow generation, partly for structural, partly for cyclical reasons. So Mastech is an example of a company that would be much more cautious on right now. Yeah, that could change, but frankly, we don't like the fundamentals, and we don't like the track record in the way we like Ferrovial.
What about now? Let's talk about maybe some upside risk to your call here. What would make you more bullish on the name?
I mean, we've seen a series of project cancellations or project delays in the renewable space recently, because really spend has really focused on other parts of the infrastructure complex. I think longer term there will be spend in renewables, but I think short term they have to get through a challenged balance sheet. They have to get through a challenged capital cash flow conversion cycle. And I think, frankly, if they improve, if some of these projects don't get cancelled or they get renewed, I think they'll benefit from that. But short term, we're pretty wary and pretty careful about Nasdaq.
And Nasdaq, though, it's interesting, Mort, you look at this name, it already got beat up a bit. I mean, it's down about 30% in the past 12 months, but you obviously don't think all the bad news is priced in at these levels.
Well, when I look at the leverage, when I look at what's happening in the direction in terms of the cash flow conversion, I'm not convinced the fundamentals are set up for this company very well, even if the sector overall benefits. I think there's other players that could benefit more in this sector long term.
All right, there's the thesis. Let's wrap this one up here. So you're telling investors buy Ferrovial based on a potential valuation uplift as it transitions to being a U.S. group, and also expectations for substantial cash flows coming for the company. And on the other hand, you're saying avoid Nasdaq as the company has a stretched balance sheet and its cash generation recently collapsing. Moritz Pott, thank you so much for joining us today. We appreciate it. That is all for the latest installment of Goodbye or Goodbye. Look out for new episodes 3 times a week at 3:30 p.m. Eastern right here.
On Meta's last earnings conference call, CEO Mark Zuckerberg said that AI is going to change advertising in a big way. And we have the perfect person to talk about that, the head of the global business group at Meta, who's in charge of advertising, among other things. Great to see you. Nicola Mendelson is here with us in Davos. So, Nicola, it's already changing advertising in many ways. So talk to us about what you're already seeing and what we may yet see in terms of the two.
Okay, so back in 22, we brought together all of the products that we have that are actually powered by AI into our Meta Advantage suite. And what we're seeing now is that our advertisers on the whole are using at least one of those products. And the reason they're doing that is because it's giving them better targeting and better performance. On average, they're seeing about a 32% increase in return on their advertising spend. So this is really significant. So this is where we are already today. We're going to continue to be investing to deliver stronger performance for our advertisers. But also when you start to think about generative AI, well, that's where we're really going to see some exciting changes, and we already are. So when it comes to, we launched last year a whole generative AI sandbox, and we're seeing our advertisers now starting to do image creation in there. We're starting to do image enhancement. We're starting to see copy being done. And so this allows advertisers to do so much more personalized marketing at scale, which I think is going to be very significant.
Can you call the end to the ad recession that played out a lot last year?
Well, we're starting to see already that, the mood here this Davos is pretty similar to last year, which is there's a cautious optimism in the air. I think advertisers are getting more comfortable in uncertainty, and we're certainly living in very uncertain times. But ultimately, advertisers are going to advertise where they're getting strong performance. And with some of the numbers that I just shared with you, they're certainly seeing that from the Meta suite of products.
And what does sort of the balance look like between, there's obviously a lot of small advertisers across the Meta platforms, but you also deal with a lot of the big advertisers. So what kind of differences are you seeing in demand between large and small companies?
Actually, one of the things that I think is wonderful about Meta is, in very much, it's always been about the democratization of digital marketing. So it doesn't matter if you're the world's biggest advertiser, the world's smallest advertiser, you still have access to the same tools. And so they're using all of them. They really are enjoying the Meta Advantage suite of products. It's really important. We're also seeing a big take-up in Reels. 3/4 of our advertisers, large and small, are actually using Reels now in their advertising. And that's not a surprise, because we're seeing that people are really enjoying Reels. We're seeing hundreds of billions, 200 billion Reel plays a day, and very high engagement. We're seeing hundreds of millions of comments or shares that are actually happening. So we're seeing really deep engagement in that Reels product. And a lot of that, of course, is also powered by AI.
And what about the uptake in terms of ads for Threads?
Well, I knew you were going to ask me on that. So we're very excited about the launch of Threads. We shared that there's been 100 million people utilizing it. We think they're really enjoying it. And, it's actually far exceeded our expectations in terms of the take-up. And we recently just launched it also in Europe as well. But to your ads question, well, it's a little too early for that. The way that we build products, I think you know this now, is that we really make sure that we get the engagement there with people and that they get there. That's what we did with Reels, that's what we did with Stories. And when we see that depth of engagement and the scale that we want to get it at, that's the point of which we'll bring in monetization. And I promise you'll be the first to know.
I promise you I will ask again.
I know you will.
Obviously, Threads is the most direct competitor to the artist formerly known as Twitter. Are you seeing any of the advertisers who had temporary or even more permanent boycotts there deploying more ad dollars on the Meta platforms?
So I think ultimately it's about where advertisers are getting their performance, and what advertisers are telling us that they're getting really strong performance on our platforms. As I said, we don't have advertising on Threads yet, but people are looking to where they can get the most return, and I'm really pleased with the fact that they're seeing that on our platforms.
I think investors are digesting what happened in the Iowa caucus. Former President Donald Trump really had a strong showing there. As we approach the election, do you think advertisers will pause their spending because of what could be another Biden-Trump rematch?
So I think what we're hearing from advertisers is they really want to understand what we're doing when it comes to elections. And we're not sitting here waiting every 4 years for what's going on in American elections. Actually, we're working on elections all over the world, every year. And we're, constantly working out what our playbook is, to think about it like that. So one of the things that we will do, that we do with elections all around the world, is actually to set up a special unit that works on the election. We've got very clear guidelines about who can advertise. People have to be registered as a political party, so that when the advertising runs, actually people can see that it's being put out there by a political party. And then any of those ads actually go into our ads library, and there are now over 15 million ads in that ads library that you and anybody can go out and have a look at. And of course, we don't just allow anything. And what you'll see is a week before the actual election in America, we will stop any new advertising. And the reason for that is because we wouldn't have time to go and actually check the validity of the claims being made. So we think that's a really important thing when it comes to the election.
Nicola Mendelson, great to see you. Thanks so much for joining us as our
It's cold.
It's cold.
What else can you say?
Thank you. Thank you for having me. Stay warm.
A federal judge blocking JetBlue's purchase of Spirit Airlines. That proposed $3.8 billion deal would have produced the country's fifth largest airline. Helene Becker, TD Cowen's senior research analyst, joins us now for more. Helene, it is great to have you on the show. Maybe just to start with, give me your response to that headline, your reaction, Helene. Were you surprised by that, or no, you saw this one coming?
No, we saw it coming. We expected that the DOJ would block the merger on antitrust grounds to begin with. And then we thought if the judge really listened to what the companies were saying, that he would come to the conclusion that this deal had to happen. But I think the DOJ wound up making a strong case and issued concerns for low fares in the South Florida market, especially for visiting friends and relatives, because that's a big part of Spirit's business plan. But when you do a little more digging, you find that Spirit may have a hard time surviving without this merger.
Well, that brings me exactly to my next question, Helene. What comes next here? Is this the end of this merger story? And if not, how are these names going to move forward?
Yeah. So, yes, it's the end of this merger for the time being. We expect that JetBlue will consider leasing in aircraft or placing an aircraft order for aircraft so it can grow organically, although it will take years to do what Spirit could have done for them. For Spirit, however, we think they've got bigger issues. If you look at their income statement, look at their balance sheet, they just raised $419 million in cash by doing sale-leaseback transactions on their aircraft, and they have had a lot of unencumbered assets that they were able to mortgage. But when airlines have cash flow problems, it kind of argues when you raise a lot of capital for going into Chapter 11 sooner rather than later if you're going to provide your own debtor in possession financing, which is what we think Spirit will do. So, Madison, from a timeline perspective, we expect Spirit to reach out to others between now and March 1st. And then we don't expect other airlines to step up, primarily because the DOJ would probably block any merger at this point for them. And then we expect that they'll file for Chapter 11 sometime during the second half of the year. And then we think, if even that late, I mean, they may do it sooner rather than later. And then we think that the lessors have no reason to negotiate lower lease terms, which is what would happen in bankruptcy, they may wind up repossessing their aircraft, in which case JetBlue could lease in the aircraft at a lower rate than by buying the company altogether. But there's also no guarantee that the lessors will keep the aircraft in the US market. There's a lot of demand worldwide for narrow-body A320s, especially given Boeing's issues. So we think that a lot of those planes are likely to wind up outside the United States.
And Elaine, I'm also curious, just as someone who covers JetBlue, how costly is this potentially going to be for the airline? What are breakup fees like here?
Yeah, actually, it's not as bad as you think, Josh. So it's a $70 million breakup fee to Spirit that JetBlue has to pay, and they've already made all the payments to shareholders. There was one more that they announced, I think, last week, like Thursday or Friday, that they had one more payment to make that would be paid at the end of the month, but that's done, and then it's a $70 million breakup fee. For JetBlue, well, you may not know, but for JetBlue, we think it's actually not a bad outcome because we think they'd be able to get those assets in a liquidation of Spirit at a better lease term than taking on all the debt that Spirit had and taking on all the encumbrances that went with Spirit. And growing organically will take longer, but they'll be able to do it more cost efficiently.
So, Helene, there's no shortage of news right now in the names that you cover. Obviously, today's news, a new CEO for JetBlue, and the Boeing elephant in the room. How can investors play this moment? And is there a buying the dip opportunity hidden underneath some of these headlines?
It's been a really tough start to the year. And the airlines canceled a lot of flights over the last, say, 4 or 5 days owing to the weather around the country, which has been pretty bad too. So here's what we think. Our top pick or best idea for 2024 is Delta. Then we have outperform ratings on Copa, the Panamanian-based airline. There are a lot of really great reasons to own the shares, not the least of which is Panama doesn't get into the issues that the rest of Latin and South America get into because they use the US dollar. Actually, Ecuador does too, but they have their own issues right now. And then when you move past those two, we still like United. We think that they'll restore seasonal capacity to leisure destinations in this summer coming up, summer 24. And then we like Sun Country, which is an ultra low cost airline based in Minneapolis. It's a spill carrier for people who can't get on Delta. About a third of their revenue comes from charters and Amazon. They fly 10 737 aircraft for Amazon. So we think there are opportunities that you can buy, but we definitely think that we're going to get more buying opportunities. We didn't do a earnings preview this quarter, as you and I have done in prior quarters. We were above consensus only for Delta. For everybody else, we were at or below consensus. So we think even with the Delta news that took the stocks down on Friday, we would wait to hear first quarter guidance from the peers and then buy the dip.
All right, so just to run through those names among others that I know you cover, Helene, but you've got picks here on Delta, Copa, United, and Sun Country. Just a reminder for our audience there. Helene, thank you so much. That was a really great conversation. Really appreciate your time on that. Now, coming up, we got the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned for all the markets news that you need.
All right, that is the closing bell on Wall Street. Let's do a quick check of the markets where we saw lots of red today across the screen and losses accelerating as the day went on there. You can see the Dow is going to finish here down about 200 and let's call it 32 points. The S&P 500, your broad gauge, also in the red, down about 18 points. And that tech-heavy Nasdaq also in the red, down about 28 points in today's trade. Of course, investors had some big bank earnings to sift through today, according to Goldman Sachs and Morgan Stanley. Also, big data coming tomorrow with that retail sales report. Kind of a window we'll get there tomorrow on the health and resilience of the consumer.
Well, we're going to get a check on some of the trending tickers, starting with a good QSR check. Shares of Restaurant Brands International, that's the parent company of Burger King, falling in today's trade. The company acquiring its largest franchisee, Carrols Restaurant Group, for $1 billion. Now, I want to mention that Carrols is climbing as much as 13%. They're at their highest highs since 2019 after that agreement to be acquired by that Burger King parent restaurant for the total enterprise value, again, of $1 billion. But not a lot of positivity on the street when it comes to our brand's trending ticker, their QSR. So maybe a little bit of mispricing when it comes to that deal. A question about the cost there, Josh. But interesting to see that there is a big reward on the street for Carrols in response to this news.
Yeah, and reports noting, Madison, this is really kind of part of this broader effort, I guess, at this company, kind of, you're right, remodeling locations, improving customer experience. And the plan apparently is once the acquisition closes, Burger King then refranchises most of the stores to new or existing smaller owners. Stocks down today, up about 13-14% over the past year.
We're going to talk about another deal. We've got chips news, right, Josh?
That's right. Chip design company Synopsys confirming its deal to acquire software developer Ansys for about $35 billion in cash and stock. The move, one of the biggest deals announced worldwide in the past year, and is set to close in the first half of next year. So this one, not a big surprise here. This was pretty well telegraphed. We had different media reports telling us this one was coming. Synopsys agreeing to buy Ansys, $35 billion cash and stock. You can kind of understand the overlap here. Synopsys offers software to design chips. Ansys makes kind of simulation software used by engineers, gives them insight into how products will actually work. Interesting, too, because Synopsys, the CEO here, relatively new on the job. He was appointed just in August, formally took the reins on January 1st, but already making big moves.
Yeah, it's interesting, particularly because it folds into the continued conversation that we've been having about just the high demand for chips. And Synopsys, as you mentioned, is a chips design company agreeing to buy that software developer. So seeing two buzzwords that we know that investors love to hear, chips and software developers coming together on this deal, seeing a little bit of a reward for these names off of that as well. And that acquisition is a move, of course, for Synopsys to expand their customer base and their suite of products as well. So getting a little bit more market share, growing their product suite, that product mix moving forward for them, Josh.
Yeah, more broadly, the deals follows HPE paying up, agreeing to pay $14 billion for Juniper. So maybe perhaps a sign that we're starting to see maybe some heating up in the tech deal making space there.
Well, it's interesting, too. I want to talk a little bit, switching gears here, to Digital World Acquisition Corp surging on the heels of former President Trump's win in the Iowa caucus last night. Trending ticker DWAC. That's the blank check company that will take Trump's social media platform public. It's on track for the highest close since July 21st of last year, and the largest percent increase since July 21st of 2023. We see this frequently when it comes to news regarding the former president, some SPACs related to the former president and his social media platforms that are popular amongst his constituents really tend to rise on his wins. And we're going to probably continue to see that moving forward. I wouldn't be surprised if DWAC is up after the New Hampshire primaries, Josh, as well.
Yeah, so Trump just won the first Republican contest in Iowa, obviously by a landslide, decisively, reinforcing this idea that it will be Biden and Trump, and maybe that giving a lift here. We just spoke with IXIC Boltanski from BTIG, and we asked him to bottom line it for us, and he said it'll be Trump versus Biden. I mean, DeSantis and Haley, according to IXIC, they will be dropping out. Other names I was watching for this news, by the way, I was looking at Rumble, which is, of course, the conservative video network backed by Peter Thiel, but that was actually down in today's trade.
Oh, interesting.
Yeah.
That's interesting. I'm going to have to double click on that later, Josh.
All right.
But yeah, as Isaac was mentioning, it's those 7 states that are going to matter, particularly because, yes, it's now, we can kind of extrapolate that it's a Biden versus Trump, but 7 states are going to be the ones to decide among those 2 who becomes the next president.
For sure. All right, moving on here. UBS raising its S&P 500 year-end target after the Fed's pivot in December, triggering an unexpected rally at the end of the year. Josh Schaefer is following this story and joins us now. Joshua.
Josh, so we have been talking for all of November and December about these S&P 500 outlooks, right? And we have been talking, a lot of people, I think our median was somewhere around 4,800 in that range. The S&P 500 almost hit 4,800 while we were having those discussions. So we've sort of been waiting to see, okay, what do strategists think as they sort of go back to the table, reassess the rally, and come back and sort of say, okay, what are we actually looking at for 24 now post-rally? UBS is now the 3rd firm that we track in the last month alone to upgrade the S&P 500 year-end target. So UBS moving from 4,850 to 5,150 on the S&P 500. That's a little over a 7% upside from where we are today, and a large part of that is what you're looking at on your screen now. Earnings. S&P 500 earnings for the full year of 2024 haven't come down as much as they normally do. We know those projections often start to come down. UBS essentially saying that given the Fed's pivot, but then also just taking a look at above trend 2024 EPS revisions, they now see the upside in their base case. Remember, when we talk about S&P 500 targets, guys, we're essentially talking about what strategists think the EPS on the S&P 500 is going to be and extrapolating that out to what that means for a price, right? So if we think earnings are going to be better, earnings drive stock performance, right? So if earnings are going to be better, then stocks will be better. That's sort of the take here from UBS. And I think overall, the takeaway for me, now 3 firms saying that in the last month, that maybe we're going to be a little bit better off than we thought.
And it's interesting because we are so early into the earnings season, of course, Josh, but I know you've also been looking into the recent investor interest in small caps. What can you tell us about how the good old Russell's doing?
Yeah, we've been talking about the market rally, right? And we can't talk about the rally over the last 2 months without talking about that Russell 2000, up over about 16% since its low in October. And Bank of America had its fund managers survey out today, and there was a really interesting chart in it for me talking about the Russell 2000. It says that for the first time since June 21, fund managers now see large caps as expected to underperform small caps. That is not a common call on Wall Street. We don't see that very often. The last time we saw it in this big of a measure was June 21. You saw it a little bit in January 2021, but not a normal call to see. But it is in line when you think about the market action that we've been showing with the Russell 2000 on the screen. It's been quite a rally for small caps, right? Yeah. With interest rates expected to come down, a lot of people on the street are highlighting that they think small caps are a smart play right now. Goldman Sachs, one of those out over the weekend, highlighting that they still like small caps, even given the rally. A lot of what people are talking about here, and a key thing to watch, Josh, you just mentioned retail sales a little bit ago, and just overall economic growth, right? Yep. The call on small caps here is that we're not going to go into a recession, that the economy is going to continue to grow, and that will be a boost for small caps. So if you're wondering about small caps, I think that's one of the key things to watch here is, do we keep seeing this robust consumer growth and the economy stay afloat? That's sort of the base case for the positive call on small caps.
Yeah, we've had some strategists recently who were positive on small caps, but then they actually started trimming their position a bit because of the rally you're talking about.
Yeah, Lori Calvasina at RBC, who's been on small caps for a while now. She's come on our air for a while now and said, it's time to buy small caps. I want to go fishing in small caps. She was one of the first strategists to come out and say, all right, maybe too many people like them.
Right.
Maybe too many people are in on small caps right now, and it's time to start wondering, should we back off a little bit? She said, one of the key signs, it was underbought. And now you're looking at it maybe being closer to overbought when we're talking about small caps. Yeah. So something to think about when you see something rally.
A few too many fans.
Right.
So, all right. Thank you, Josh. Appreciate it. Moving on here, markets, we know, have been hard to gauge to start the new year, and recent econ data has made it even harder to forecast what's to come. So as investors look to reshuffle their portfolios in these volatile times, where should they be focused? We have just the man to tell us. John Mayer, Global X Chief Investment Officer, joins us now. John, it is great to see you. Thank you for joining us.
Thank you for having me.
Maybe we'll start, John. Listen, today we got some big bank earnings, Goldman, Morgan Stanley. So officially we're in sort of peak earnings time now. Just broadly, John, when you look at this earnings season, are you expecting to hear good things? I mean, is this going to be a positive catalyst for the market?
Well, banks typically come out first, and so far the numbers have been fairly good. This is very early in the season, but I do believe that we're coming out of the earnings recession, and you are going to see some growth probably 3 or 4% overall in the S&P 500. But you're going to see some revisions down. It's more like 6 or 7% expected. I think that will help the market, particularly when you hear some of these executives talking about what's going on in the space, whether they're talking about AI, CapEx, things that will help them improve their overall efficiency. And I think that's what the market is seeing. Every time you see kind of a mass layoff, not a positive, but you do see companies tend to do well. So the improvement in efficiency, I think, is really important. And we believe we are at peak interest rates. And I think that's important as well, because as interest rates decline, the market breadth will widen out. As Josh was talking about, I do believe small caps will continue to be a beneficiary, mid and small caps.
Well, going into efficiency, Meta's year of efficiency, really rewarding that name in 2023. When you look at the broader big tech rally that we've seen and kind of the narrowness of that rally, what will be the catalyst for more growth this earnings cycle for those 7 names?
Well, I think those 7 names are difficult because the market certainly was getting ahead of itself. Now, in November and December, we saw that market breadth widening out, particularly when the market got a hold of that potentially that the Fed was at peak interest rates and potentially cutting rates. So I think that was very important to the market. But there's still a lot of enthusiasm for most, not all of the 7, but most of those 7. Nvidia chips, where else are you going to get them? AMD is up a lot today on some news and earnings. But I think some of those companies are in such good positions. AI is all about data. Those companies have tremendous access to data.
And John, I want to get your check on the Fed. We continue to hear from our policymakers. Market's expectation is Fed's going to cut early and they're going to cut often. Is that what you see?
Well, it's coming down a little bit. So the market is expecting 4 cuts this year. The first one in March. Last week it was 80%. Right. This week it's 65%. Let's see what it is next week. The market's telling us today that potentially inflation coming back with some oil disruption potentially in the Red Sea. That's an issue. Some of the data, the economic data is murky. The CPI numbers ticked up a little bit, although the PPI numbers are pretty good. So there's uncertainty, and the labor market is stronger than expected. So there is some uncertainty in the macroeconomic data, and I think that's what the market is reacting to right now, and you're seeing rates go up a little bit.
And the market action today, in particular after Waller's comments, really throwing some red on my screen when it comes to the trade today. What is your advice for investors on Fed speak in particular as we kind of navigate these rate cuts to come this year? What should investors be thinking about on days when they hear Fed speak, when they hear dovish or hawkish commentary?
For the everyday investor, I think they should kind of block out some of the day-to-day information. If you look at the environment that we're in and what factors will do well in the market, we think quality and low volatility will do well when there's an economic slowdown. We're not going to have GDP numbers like we did in the fourth quarter. Inevitably, we're going to slow down. But I don't believe we're going into a recession. I think the Fed has been able to navigate a slower, a softer landing, which is possible.
You didn't want to say it almost. I can see it in your eyes that you didn't want to say soft landing.
It's been overused, right? So, but I think it's possible.
Yeah. And John, you mentioned the word quality there. You're looking for quality names. How do you define quality? What do you screen for that?
Right.
Companies that have consistent earnings, strong cash flows, that are less reliant on the economic cycles. So I think those are the factors that we look at when we're looking at quality.
Any big risks that you're concerned about for the year to come? You mentioned the Red Sea. Is that at the top of your list?
There are geopolitical risks abound, right? So that's a concern. If the issues in the Middle East broaden out, that could be certainly an issue. There's an election coming up that certainly could move markets one way or another, but I think we're a ways away from that. I think you need to be more 3 or 4 months away from the actual election.
Sure.
So geopolitical risks are my concern right now.
Yeah, there's plenty of geopolitical tension to go around, so that does make sense. John, thank you so much for joining us. Thanks for coming on set. We really appreciate that. Now, coming up, a busy few days, leaving Apple shares in the red and its market cap second to Microsoft. We're going to take a bite out of the latest from the tech giant on the other side of this break. The White House confirming the United States launched more attacks on Houthi targets in Yemen. And it follows news that Shell is suspending all shipments through the Red Sea. Inez Ferry's here with the latest. Inez, what do you got for us?
Yeah, that's right, Madison. So it's been a volatile session throughout the day. We do have markets which have been mixed when it comes to oil, WTI ending slightly lower, and you have Brent crude that ended slightly higher. Of course, all eyes are on the Middle East and tensions in that area. Iran reportedly launched a strike against a target in northern Iraq and also in Syria. So, of course, this stokes fears of greater, broader tensions in the area. And this comes amid the Red Sea tensions with respect to the Houthi attacks on vessels in the area and U.S. and its allies retaliatory attacks against the Houthi rebels. And you have had shipping companies that have diverted their shipments through the Red Sea, which is that body of water that connects to the Suez Canal. It's the shortest distance between Asia and Europe. And now Shell has said that it has stopped its shipments through the area as well. Whereas before, as with the weeks leading up, we have seen more cargo of goods, grains, et cetera, that have diverted. Now we are seeing a lot more of oil shipments. You have Torm, which is the Danish vessel company, or the oil tanker that has also last week announced that it would avoid that area altogether. They have 80 vessels that carry refined products. So that has had an impact on Brent prices and WTI. But just want to mention one quick mention with WTI ending lower, you do have colder temperatures across a large part of the U.S. and especially in the southern states where you have some refineries, and that can impact refinery capacity as well there. So keep an eye out on that.
All right, we will do. And yes, thank you so much for that. I appreciate it.
Thank you.
A busy few days for Apple. Shares down on news that the company is offering discounts on its newer iPhones in China amid slow demand, as well as news that Apple Watches may be losing the blood oxygen feature to avoid a U.S. import ban. Joining us now to break this all down is Ben Beharin, Creative Strategy CEO and Principal Analyst. Ben, it is always great to have you on the program. There are, it's a few places I could start, Ben, a few different headlines, but maybe I'll begin, Ben, with these reports we're seeing that Apple is offering these discounts in China, Ben, including on, its latest and greatest iPhones. You know Apple backwards and forwards, Ben. How rare is it for Apple to do that in China, and why do you think Tim Cook is doing that? Is that signaling weakening demand over there, increasing local competition? What do you think?
Yeah, I think there's a mix of things. This has obviously always been a strong quarter thanks to Chinese New Year for iPhone in China. I know there's been some, because of those promotions and because of Chinese New Year, there's been some, not necessarily discounts, but promotions that have been happening as well. We're not seeing a tremendous amount of demand softness, if you will. But I do think there's variations between all of those models. For example, China is continuing to be strong in the upper end of that price band. So higher ASP, more Pro Max is definitely been part of that mix shift. So I think part of that sort of rebalancing of the portfolio, could be part of it, and where carriers are looking to do some of those promotions. But I think, again, right, just on the back of what we typically see in Chinese New Year, this has typically been a relatively strong quarter, but that mix shift is going to be kind of one of the bigger questions, is how much volume versus how much is the ASP rise in that region.
Ben, does this tell you that Tim Cook is worried about sales in China?
I don't think so. I've seen pockets of this before. I think, again, we're in a period of recovery for the smartphone market in general. China had some signals of that last year, so I think there was some optimism going into this quarter. But again, one of the biggest dynamics that I think is impacting the industry as a whole is that it's been evident now for 6 to 8 months that the smartphone replacement cycle is lengthening in every region, which includes China. China typically has had the shortest refreshment cycle of anyone, and that's now expanding to anywhere between 3 and 6 months based on price band. That in itself is having different implications on the market as a whole. And so I think there's some rebalancing again of that strategy of how carriers are going to start to move some of those promotions to try to keep some of those sales afloat.
And Ben, there's a lot of investor interest in Huawei as well. I'm just interested to get your take. How much of a real competitive threat do you think Huawei actually poses to Apple in China?
It still remains to be unseen. That's a big part of the debate. Obviously, they were amongst one of the biggest competitors, especially in premium, for Apple prior to some of the sanctions that got hit on them from the U.S. It feels like that's starting to grow again in momentum, but again, it's still relatively small. They're also trying to do this with some of their own silicon, which is raising a little bit of questions in terms of the product quality there. I think the next few quarters will probably be much more telling as to the strength of Huawei, but there is a lot of increasing competition there. Obviously, Xiaomi continues to be strong, and you see a range of products from BBK Group like Oppo and Vivo continuing to be strong there. So yes, increased competition, lengthening smartphone cycles, all those things adding to dynamic it's really hitting everybody in the region.
And all of that is weighing on Apple's sales, Ben. I'm curious, to what extent does this parlay into movement in the United States? Do we potentially see discounts on iPhones coming up here in America?
Probably not. I mean, I think, again, we see very aggressive carrier promotions already in America. And so I think that's going to continue. You're still seeing a lot of people a lot of carriers give those discounts either as free phones or aggressive trade-ins. That remains to be relatively strong. But I think the first 6 months of a launch cycle is always the strongest. After that, it starts to tail, and you see the N-1, N-2 SKUs start to sell better. So I think it's really at this point a matter of how aggressive the carriers want to be. When you're on a payment plan, $100 versus $50 is not that big of a deal in terms of monthly payments. It's really just about how much are they willing to give in either trade-ins or aggressive promotions.
And Ben, switching gears here a bit, let's talk about the watch as well, also making all kinds of headlines. My understanding, Ben, correct me if I'm wrong, is that this week Apple finds out, listen, if they can keep selling the watch in the US with that blood oxygen feature enabled, if the ruling were to go against them, Ben, what do you think Apple's play is? Do they appeal? Do they settle with Massimo? Do they develop their own technology?
Yeah, I think a settlement's unlikely, Josh. I think the big question is, worst case scenario is they disable the feature entirely, which again, I think comes back to a couple of different factors. There's obviously ways to do blood oxygen sensor without infringing on Massimo's patents. There's a bunch of companies that do this and implement that feature. So whether or not that's a minimization of the feature via a software update, or worst case scenario that they take that up, they take the feature out entirely. If they take that feature out entirely, I don't really think that will impact sales much, but it is an unfortunate element given that that's a useful feature for obviously preventative health and other things that go into some of the Apple Watch's value proposition. But I'm not sure that would hurt sales in that worst case scenario.
And Ben, I want to get you out of here on this. This whole big, ugly fight with Massimo, Ben, does it bring up for you, again, as an analyst who's been covering Apple a long time, does it raise any kind of bigger, broader questions about Apple's ambitions in health?
Only that it, again, to go deeper into some of these features where there might be more IP protection from companies who have decades of IP in the healthcare industry, the more deeper you go into that, the harder that might be. And there again is where maybe some acquisitions make sense, maybe some other areas where they can invent and create some of their own additional IP around those features will start to take shape. But obviously there's consumer health type products, and then there's ones that get much more deeper into how the regulatory and IP goes for those companies. So I think it gets harder, but I don't think this hurts their ambition.
All right, Ben Baharin, we're going to have to leave it there. Thank you so much for joining us. We're going to move on to the big bank earnings. Goldman Sachs and Morgan Stanley out with earnings this morning. Goldman beating Wall Street expectations, reporting a 51% profit. Different story, though, for Morgan Stanley. Fixed income and equities trading revenue fell short of forecasts, and the bank warned of lower margins in its wealth business to come. And that comes as the other big banks reported last week, projecting quite a mixed picture for the financial sector and an uncertain outlook for the regional banks. So to get some clarity here, we've got Chris McGrady, head of U.S. Bank Research at KBW. And Chris, let's start right there. We've got this mixed picture so far from bank earnings. How should investors be digesting that picture?
Sure, thanks for having me back. What we've seen thus far in earnings, and it's early, is really we're going through a bottoming process for the traditional commercial banks. We're seeing net interest income, or the top line revenue, that's in the process of bottoming. And that's a good thing, because that destroyed about 25% of earnings last year. The question that we're having is, how is the full effect of interest rates going to play through to credit quality, and that process is normalizing.
And Chris, I'm interested, obviously for the banks, we saw this, late year rally there. They've moved, some of those names have moved hard to the upside. How does valuation generally look to you for the sector, Chris, here? Yeah, they're cheap. Banks are always cheap. In my 20-year career, they've always been cheap. And that's because of the value aspect of the business, the regulation. What's interesting is the speed at which the market re-rated this group, right? We went from 8 to 9 times earnings to 11 to 12 pretty instantaneously when the Fed, the pivot in December. And so what we think is fair value for the group right now is around 10, 11 times. And there's a lot of work we've done with where the level of interest rates are and the multiples. So we had a big run into the year. It's not surprising us that we've seen some of the year come out of it.
And I'm curious then, when it comes to the right multiple on banks following their earnings, what is the single biggest catalyst for further growth that the market may not be pricing in fully right now?
Right. I think the biggest uncertainty that we're looking at is, how is the economy going to react on a lagged effect to higher interest rates, right? We saw, 500 basis point increase in rates. That takes some time to go through the economy. If the economy and the banks, go through 2024 and asset quality turns to hold up, and we think it will, that's the biggest re-rating opportunity for the sector. Because I think a lot of conversations that we're still having is, how did this perform? How did this company or how did this industry perform during 2008? And now that's a tough comparison. Things are different. A lot of the risk has moved out of the banks, but banks need to be tested. The balance sheets need to be tested from a credit perspective. And Chris, before we get you out of here, I want to get your take on names that you like here, where you think investors should be committing capital. One name here is Webster Financial. Why, Chris, is that a buy? Sure, Josh, the 3 themes that we've identified for the year, really, we want to own banks that grow tangible book. There's a big correlation between book value growth and stock performance. We want to own select exposure to the capital markets. We like Goldman. And then we want to own banks that make a lot of money. Webster is that last camp. They also grow tangible book pretty quickly. We think Webster can make a 20% return on equity, and the stock sells for 8 times earnings. So as the economy transitions to this higher rate environment, we think investors will get more comfortable about credit, and to me, with the opportunity to re-rate. And what do you like about East West Bancorp? Similar, both banks, East West and Webster, can do fairly well in a higher for longer scenario. What we like about both of these companies is, again, the high return, the high ROEs, mid to high teen ROEs, selling at an 8 PE. We also like the fact that East West told the market last quarter that they were confident in their business and they started repurchasing stock. So we like when companies buy back stock. And we like the positive forward guidance, at least the street does, Chris. Thank you so much. We really appreciate you coming on. That was Chris McGratty. Now coming up, we've got more from the 2024 World Economic Forum as our friends Brian Sazi and Julie Hyman sit down with Coinbase's Chief Policy Officer to discuss the approval of spot Bitcoin ETFs. More Yahoo Finance after this.
news, of course, last week on the crypto front when the SEC approved a raft of spot Bitcoin ETFs. The custodian for many of those ETFs is Coinbase, and Faryar Shirzad, who is Coinbase Chief Policy Officer, is joining us here in Davos. Thank you so much for being here. We appreciate it.
Oh, thanks for having me on.
So let us say diplomatically, the SEC has sometimes been at odds with the world of crypto. Do these approvals mark a new chapter there, a new sort of rapprochement, or no?
Well, in the end, the courts had to intervene, and they pretty definitively said that the basis of having turned down Grayscale's application was arbitrary, capricious, and an abuse of power. So really, the agency didn't have much room other than to go ahead and approve the applications. But it's a big development. It does two things. One, it brings a whole new raft of investors into the crypto economy, which is really exciting. And it does symbolically put the SEC on record as blessing an important crypto product. And I think both of those are a big deal.
In light of this news, what type of questions are you getting from world leaders here on the ground about crypto?
Well, people watch the U.S. developments, but the verdict on crypto has largely been turned in by the G20. You have virtually every G20 economy having adopted some framework of regulation or in the process of adopting. So the EU, UK, Australia, Brazil, Singapore. The world economy has moved forward. They're integrating crypto into their economies and into their financial systems. And in a way, the debate in the United States has made the U.S. less relevant in that discussion. I think countries see an opportunity to be a leader in the next iteration of the internet, Web3, and they're taking advantage of that. And you know, obviously, we at Coinbase are hopeful the U.S. will catch up.
I mean, on sort of a similar note, you know, Davos in some years, past years, when crypto was more at a high in its cycle, you had crypto stuff everywhere here.
Yeah.
Crypto signage, crypto companies. Now there are fewer, but to your point, it feels a little more settled maybe. Kind of where are we in that arc of institutionalization, adoption, sort of it growing up in a way?
Yeah, I think that's right. I think there's a lot more institutional players and mainstream companies, financial companies and non-financials who are getting into crypto. So it's less of a mysterious phenomenon. The trading hype that you saw a couple of years ago is less defining as what the sector is. I think the verdict is in that the technology is unassailably an improvement over the traditional financial system. And how it gets integrated is really the question in front of all of us. So most central banks are looking at developing some sort of tokenized fiat currency. Most economies are developing rules around crypto trading. A lot of economies are integrating crypto as a payment mechanism. And I think that is the story of this Davos and of the year ahead. And I think that's exciting, much more exciting than what we saw in the past.
So you mentioned the U.S. is lagging in this area. So is that going to continue to be an obstacle for the U.S. crypto industry? Do you see any signs of progress on that front?
Well, the crypto market in the U.S. is large, even with that uncertainty. You have 52 million Americans who own crypto. It's a huge segment of the population. More people have crypto than own electric vehicles, than have union cards. So it's a huge part of the American electorate. And in Congress, you have bipartisan support for very constructive crypto legislation. So you had two committees pass important legislation that we expect to come to the floor in probably Q1. We expect that to pass the House. And so there's big, important bipartisan efforts towards providing regulatory clarity. And I think we'll get there. Maybe it's this year, maybe it's next, but it'll happen.
I had a Davos. I talked to the managing director of the IMF, Kristalina Georgieva, and I think she was open and viewed crypto as a good payments mechanism, but stopped short in saying it should be viewed as money. Do you think it should be viewed as money? And if not, do you think we get to that point?
Oh, there's no question. The ability to move value electronically as easily as you send a text is already being adopted by hundreds of millions of people around the world, and governments are now exploring it. So as policymakers kind of get their minds around crypto, the public is also getting its mind around crypto, and they're voting with their feet. A huge portion of the global population owns crypto. You have trillions of dollars of stablecoin-based settlement occurring every year. So,
but it's not that easy though. A lot of the time, right? I mean, there's still, even though it's supposed to be this frictionless payment, I mean, a lot of the time, it's not yet.
Yeah.
If you're trying to buy or trade when, God forbid, pay for something in Bitcoin, right?
Yeah.
So when When are we going to get to that point?
Yeah, so the technology for sure is an advance. The scalability, the speed, and the cost is what all this developer activity that you're seeing is all built around. So we at Coinbase launched Base, which is our own proprietary protocol that actually is a gigantic step forward on all three of those factors. And you're seeing enormous amounts of developer activity on Base as developers try to build new applications that solve that speed, scalability, security trilemma. And so the innovation is catching up to the demand and the need, and it's exciting to see. It'll happen. It's happening quickly, but we're not quite there, but we'll get there.
Over the next 6 months, where will you be spending most of your time?
Well, from a policy perspective, it's hard to focus in any one area. The U.S. is obviously significant. The legislation will take up a lot of energy, and that'll be a big, important focus of ours. But we're very active in all the jurisdictions that are engaged in rulemaking right now. So the MiCA regulations in the European Union are going through what are known as the Level 2 technical standard process. That'll take about a year. We're very focused on that. The UK is developing an excellent framework around crypto and stablecoins. We're working on that. Australia just came out with a consultation. South Korea is engaged in a consultation. The Brazilians are chairing the G20 in their own consultation process. So there's no shortage of areas for us to work on, and we're committed to being a part of all those debates.
Sounds like you're getting a lot of airline miles in the coming year. Faryar Shirzad of Coinbase, thank you so much.
All right, thank you both. Thanks for having me on.
Again, that was Coinbase's Chief Policy Officer sounding hopeful in the future of crypto, particularly in the U.S. after the SEC did approve those spot Bitcoin ETFs. And Josh, I had the pleasure of talking with Faryar last year at Davos. And what he said to me then was that 2023 was going to be the year that the SEC took control over the crypto market. And it didn't necessarily happen in 2023. He was just a couple of weeks off on that estimation. But interesting to see that he still seems to feel like that regulation adds some legitimacy to this alternative asset class. He doesn't feel like, and Julie's first question was so smart there, is the SEC a friend or foe of this community that's typically viewed it as a little bit of a foe? He's very bullish, I guess I could say, on that relationship and that regulatory measure moving forward.
Yeah, we'll see how it shakes out. Coinbase is interesting because it's starting the year, it's down about 20% this year. Yep. It's kind of a rough start, but I mean, obviously the context being, listen, it's had a remarkable run. It's still up even then, about 150% over the past 12 months. But, you know, this will be just a big, important, and fun theme to watch this year. These new spot Bitcoin ETFs, what do the flows look like? Right. Where's the demand coming from? Besides the ETF issuers, who are some of the winners? Is it Coinbase? Is it Robinhood? Or you know, listen to some of these Bitcoin miners too, by the way. You can check out names like Riot Platforms down about 30% this year. ClearSpark also down about 30%. Is that already spot Bitcoin ETFs kind of having an impact here?
Well, Josh, as you mentioned, I want to put out this headline that we saw across during our show here. Traders pulling out $500 million out of that Grayscale Bitcoin ETF. It's the only U.S. spot Bitcoin ETF with net daily outflows since its debut, and that money likely going into cheaper Bitcoin funds. That's according to Bloomberg Intelligence. But Grayscale dominating this market for so long, and then perhaps we're seeing some outflows here because of that competition now that other players are able to get in this space.
Competition from a lot of big names,
right,
for sure. Coming up, we're headed out to Davos for the 2024 World Economic Forum as Brian and Julie speak with former Microsoft CEO Bill Gates. You won't want to miss that chat. Stick around. Yahoo Finance taking a closer look into the state of healthcare with Bill Gates at the World Economic Forum, former Microsoft CEO and co-chair of the Gates Foundation, voicing his worries on where the world is in terms of focusing on health issues. Take a listen.
I'm a little worried. The world's dealing with a lot of challenges right now. And the fact that, we still have 5 million children die before the age of 5. It isn't as visual. It's not like a plane crashing or a bomb hitting a building. And yet, these deaths one by one add up to that 5 million. And we have made progress. At the turn of the century, that number was 10 million. Vaccines are a big part of that. The last few years with the pandemic, our progress has plateaued. And in fact, if we don't maintain attention, if we don't fund this vaccine fund that's been the most effective spending of aid dollars, we could actually see that number go back up. So staying on the agenda, for anything to stay on the agenda is hard. Health deserves to be on that agenda, particularly health in the poorest countries.
And of course, a lot of the work you do at the foundation is marrying tech and innovation with some of these really thorny problems like health. You have brought a couple of items that sort of combine scientific advances.
Too.
Yeah, he's got his backpack. Just it shows. I mean, a lot of these things are portable. They're small. They're easy to carry around. So I just wanted to give people examples, right, of what we're talking about. So this here is an HPV single-dose vaccine. Talk us through what that is.
Yeah, it's kind of amazing. Vaccines often start in the rich world, even if the need is everywhere. This HPV protects women from cervical cancer. And when it started out, we knew that 3 doses would work, but the foundation funded a lot of studies that showed that the vaccine is so good that a single dose is enough for full protection. And that means we can reach a lot more women, twice as many as if it was a 2-dose vaccine. So that's a very new thing. The other show and tell we've got, you're probably familiar with this instrument when it's connected up to a $20,000 box. Here we're getting the cost to be in the $400 or $500 range, and we're actually putting a lot of software with it so that as you scan a pregnant woman, you can say, okay, will this delivery be challenged, so you have to get to a health center, or will it be an easy delivery? And so we can prevent about 50% of maternal death by being able to tell in advance, will there be problems?
What is it, when you're traveling around the world and you're bringing this technology to these lower income countries, what are some of the biggest barriers that you see? Is it just the cost? Is it the doctors, the number of doctors on the ground, or is it just all the above?
Well, basically, most people don't get to see a doctor. And so you want to make it so even somebody without full medical training, because the software is doing the analysis. In the US, or any rich country, a very well-trained person has to look at this image data and try to figure out what they're seeing. We avoid that completely because it would never work in places like Africa. Keeping the funding for primary health care as the African countries have financial challenges. They're paying higher interest rates. It's a tough cycle for them. And so it's got to be very inexpensive technology.
And what about policy? Is that a barrier as well in some countries?
Getting countries to adopt new technologies, when we can show that, for example, the vaccine works in a single dose, we do get quick take-up. We work with people like WHO that set global standards. We're a very substantial funder of the work that WHO does.
There's been some talk initially here that the world remains still unprepared for the next pandemic. Do you agree with that?
Oh, absolutely. The speed at which we've lost attention on what we need in terms of systems and tools is rather stunning. People have gone to, hey, I'd rather not talk about it. And of course, looking back and saying, okay, we made some mistakes. What did we learn? What would we do next time? There's not enough of that happening.
And what do you think needs to be done then on that front?
Well, I wrote a book in order to push on this. I'd say I've learned a lot since then. We need to invent new tools. Our vaccine doesn't last long enough. It doesn't provide broad enough protection. It doesn't block infection. It's a miracle in terms of preventing severe disease. But, we didn't get it as soon as we'd wanted to. Diagnostics, you had to wait to get diagnosed, and that meant that people were still spreading the disease. A few countries did that well, and they had a much lower death rate. The sewage sampling, where you could actually see the virus in a population, we need to have that up and running all the time so that we see these things way quicker than we would otherwise. And then we need to staff the global organization so that we do fire drills. For fires, we do drills. For military war games, we do drills. Sadly, pandemics needs to be added to that list of something that when it happens, you're ready to go.
Are you surprised by a lot of the talk on vaccine fatigue? And this is, I think, primarily really focused on the United States.
Well, sadly, the fact that the pandemic raised a lot of misinformation about vaccine and increased vaccine hesitancy, that's not just in the United States. Vaccines are phenomenal. You have to work to build trust in that because it's kind of not intuitive that you stick a metal needle in a child's arm, they cry, and that's the most important thing to make sure they don't die of measles or dozens of other diseases. In fact, we're using vaccines to actually eradicate polio. By getting enough vaccines out, we'll make that a disease that completely goes away, which just shows that if we accept vaccines, we get them out, fund them, it's pretty phenomenal.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there is more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
It's time now for What to Watch coming up on Wednesday, January 17th. Taking a look at the economy. We're going to have new U.S. retail sales data coming out in the morning at 8:30 a.m. Eastern. Economists expect the holiday shopping season to drive sales higher. The estimate is for a gain of 0.4% last month, and that would follow the 0.3% jump up in November. We're also going to get our first beige book of 2024 from the Federal Reserve. That provides an economic snapshot from the 12 district banks about conditions in their respective regions.
And on the earnings front, financials in focus. Charles Schwab, Discover, U.S. Bancorp, and Citizens Financial all reporting fourth quarter results for 2023 tomorrow.
And moving over to the Fed, we'll be hearing from a trio of Fed officials: Federal Reserve Bank of New York President John Williams, we got Fed Vice Chair for Supervision Michael Barr, and Fed Governor Michelle Baumann, all slated to speak. That comes after Waller speaking today, saying that rate cuts could be coming, but might not be as soon as markets think. And we've been talking about this all day, Josh, but that really poured some cold water on the market action today.
For sure. And spinning ahead to tomorrow.
Yep.
What's on the radar, right? So we had big banks today.
Yep.
At Goldman and Morgan Stanley. Another big item this week is going to be obviously retail sales data. We get that tomorrow. Here's what we're looking for. Retail sales expected, Madison, to rise 0.4% in December. That would be an increase from the 0.3% gain seen in November. And obviously we watch this closely because American consumers are, of course, the big engine of the American economy. And we've seen them really holding up, right? Because that sturdy labor market, sub 4% unemployment, wage growth has been strong. On the other hand, we're hearing about dwindling savings, the resumption of student loan payments. So it'll be very interesting tomorrow to see how that holds up.
particularly when we continue to hear about consumers putting more of their spending on credit. We keep hearing this story with buy now, pay later. One of our guests earlier mentioning the credit tightening that we're seeing. To what extent does that start to weigh on consumers? And to what extent do we see some seasonality here? Obviously, spending is going to be up over the holidays, so I think that's something to factor in. I'm looking ahead to the Beige Book. We get 8 of these per year, and I love to hear some Fed commentary. I love to do a command search.
Commentary.
I love Fed commentary.
You're in the right profession, Madison.
Thank you. I think so as well. But it's just fun to see, do we get any clues as to what these folks are thinking, particularly, we analyze their Fed speak all day. I like to have it on paper so I can see how many times they mention Taylor
Loves
Swift.
the Fed commentary. You learn something new every day.
Exactly.
About Madison Mills. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow starting at 9 a.m. Eastern for more of our coverage from the World Economic Forum in Davos, Switzerland. Brian Sozzi, Julie Hyman have another jam-packed day of heavy-hitting interviews, including Cisco CEO Chuck Robbins, Salesforce CEO Mark Benioff, and Nasdaq CEO Adina Friedman at 3 p.m. Eastern. For all of your coverage, come back here leading up to and after the closing bell. See you then.